So the recent T-bills auction just closed at 2.0% per annum, which is even lower than the CPF-OA interest rate of 2.5%. Now, I am very sure that you have come across articles, blog posts, content, videos, all telling you, to switch from T-bills to go for REITs, real estate investment trust. And it doesn't even have to be individual REITs, because if you look at CLR, REIT ETF from Moomoo app, it is yielding you around 6% per annum of dividends. I know how attractive this sounds because you're upgrading from a 2% per annum yield to become a 6% per annum yield. Literally just triple the returns based on this switch of asset. But let me get this straight and repeat again. They are not at the same risk level when you compare T-bills versus REITs. And if you disagree and you want a further discussion, welcome to join my group at over 20,000 members at the Honey Money SG Telegram group for free to get your latest news on investments. I want to be very clear on this position that I am not against REITs. In fact, I have invested in REITs before and I fully understand what am I investing in. I just want people to open their eyes and see, which is why I made this video. The reason why someone wants to invest in REITs and choose it as an option is because they want some income and maybe a little bit of long-term growth if you invest for the long term. This is what REITs is essentially for. You are into property play and your rental income will come in as distributions. This is also on the assumption that you are willing to take in more risks and hence REITs can complement your portfolio, assuming you have the suitable risk appetite. But it is not correct to say that REITs can replace T-bills because they are entirely different set of products, entirely different level of risk. So REITs can never replace T-bills in terms of the safety and capital guarantee aspect. Why REITs are really popular is because they are a strong alternative to property investing, where property investing requires a huge amount of capital as down payment, plus the fact that you have various fees to maintain that property. In fact, I went through the previous video where I compared between individual REITs versus REIT ETF, which one is better, and I'm going to host an event with Moomoo on the 20th of June. So if you're free, go and join this event for free. Go and register for it, fill up the Google form and see us live at the physical event at Moomoo Singapore office on 20th of June. It is free lah. Just click on the link and join. But ultimately, you have to realize that stock picking for REITs is another level. It is so much different from T-bills. Unless you understand the underlying business as well as able to read financial reports and the news surrounding these REITs to make an informed decision on what to invest in. So if you ask me what is the best way to invest in REITs, as a beginner, I feel that you can go with Moomoo app, click on markets, then SG, then REITs. And this is where you can compare the list of SG REITs. If you click into a single REIT like C3AU, CapitaLand, Integrated Commercial Trust, and see the dividend yield, the PB ratio, all the statistics that you need to analyze your position. You can also use Moomoo app to analyze the company financials and revenue breakdown to see if it fits your appetite. So using Moomoo app to research on REITs is a very efficient and convenient tool. But let's now compare how different is T-bills compared to REITs. Number one, let's talk about risk profile. If we look at T-bills, T-bills are ultimately backed by the Singapore government. So they are virtually risk-free because they are capital guaranteed and you get a fixed return assuming you hold till the end of maturity. Everything is guaranteed from the return to the capital, so there's really like zero risk with T-bills. But if you look at REITs on the other hand, it is really behaving like a stock where it is subject to market volatility and the price fluctuates day in and day out every other workday. Not only that, there are also underlying risk factors like interest rate risk and economic risk and other news that may affect the REIT. Most importantly, the returns are not guaranteed, and in returns we are talking about distributions or dividends. Dividends are never guaranteed, even though they may have a consistent trend over the years, because past performance is not a guarantee of future performance. I also want to highlight another fact about REIT that most people may miss out on, which is the foreign currency exchange rate risk. Now, if all the properties of a particular REIT are based in Singapore, then yes, it is considered a relatively safe haven for property. There's no foreign currency exchange risk, but what happens if this particular REIT diversifies across the world globally? And that is where foreign currency exposure comes up. And one very particular good example is BUOU, Fraser's Logistics and Commercial Trust, because it has exposure to Australian and European properties, which means that there's foreign currency exposure to AUD and Euro. So if you look at Moomoo app for BUOU, Frasers Logistics and Commercial Trust, you will realize that they have substantial exposure to Australian and European properties, which means that if the currency works against the Singapore dollars, there is going to be a foreign exchange loss due to the unfavorable currency exchange. And that may lead to a decrease in distributions, which means your returns will be down. For example, if you look at the Australian dollar versus Singapore dollars trend, it is trending down. And it's not so good for Euro dollars versus SGD trend as well, which is also trending down. And most recently, if you are invested in the US market, you will realize that USD versus SGD is trending down even further as well. Okay, these are for those properties with US exposure. So don't just look at the overall distribution yield or dividend yield. You have to be aware of the risk. And one very important risk is foreign currency risk that most people miss out. Secondly, let's talk about the returns, because the returns of T-bills is highly predictable. Okay, it is a fixed return guaranteed when you hold to maturity, and in the most recent number, it was 2.0% per annum. Whereas if you look at REITs, it can give you like 5, 6, or even 7% dividend yield or distribution yield. But let's remember that REITs is ultimately a business, and business are exposed to risk like occupancy, like interest rate, rental income, and interest costs, and all that stuff that you are not able to control as an investor. So the returns in the form of dividends may increase or decrease over time depending on how the business is working out for the REIT. And a falling distribution per unit or DPU will lead to a death spiral in terms of the REIT price. Because if you look at it, if you have lower REIT distributions, then less people will want to invest in this REIT, causing a lower demand for this REIT, and then lesser people will buy this REIT, causing the stock price to fall. Thirdly, let's talk about capital preservation, because T-bills are ultimately a very good source of capital preservation. It is backed by the government. There will be no reduction in capital, assuming you hold till maturity. This is not the case for REITs then, because REITs are traded on the public market and securities exchange, which means that there are fluctuations in and out. There are big institutions buying in and selling away, and REITs may lose value due to falling property valuations, poor management, or rising interest rates. Now, here is the bull case scenario, because we are all expecting like the interest rates to be cut by the Federal Reserve, right? So interest rates cut, the interest cost decreases, REITs are able to borrow more money to expand their properties and more returns for the shareholders. So that is the bull case scenario, which causes the REIT prices to go up. But if you look at the other hand, what is the bear case scenario? Okay, let's say for this year, the rate cut did not materialize. Okay, we are staying at high interest rates for a longer period. Then the REITs may continue to suffer from high borrowing costs from the interest rates, and the stock price may not even move, or at worst, decline, which is why it's not a very good capital preservation tool if you want to compare REITs with T-bills. Next, let's talk about liquidity and horizon, because T-bills is like a fixed maturity period from 6 months to 1 year. So you are very sure on how long you should hold it, either 6 months or 1 year. So there is a good time frame. But REITs, you have to invest for the long term, and sometimes you may enter at a very bad market timing. And the nature of REITs is that it is highly liquid and tradable in the public exchange. So many people who see deep losses in their REITs are unable to hold through the market volatility. Hence, they cannot enjoy the long-term returns coming from either the distributions or the capital gain. So T-bills having a lower liquidity and a fixed time frame may be better for people who cannot stomach volatility. So then if you ask me how to choose between REITs versus T-bills, which one should I go for? I'll say that someone who chooses T-bills would prioritize on safety, certainty, and short-term goals. Whereas someone who prefer to go for REIT investments will be probably going for dividend income and slight capital growth, but they must be aware of the risks presented to them. Once again, I'm not against REITs. In fact, I have invested in REITs long time ago. I just want to offer this point of view to people who may be, clouded by different articles and different blog posts pushing your to switch from T-bills to REITs. I think that's a very dangerous mindset. And they can both coexist in the same diversified portfolio so that you can have 50% REITs and 50% T-bills to complement each other. One having a rather safe nature and one having a market-based result. So if you're ready to start investing in REITs, you can take a look at Moomoo, because they're offering 0 commission for the first year for new users who sign up using my link. The 0 commission applies to both Singapore REITs and Singapore stocks. terms and conditions apply. Moomoo also offers real-time market analysis, which is very useful when you want to make buy or sell decisions. Furthermore, get up to 820 Singapore dollars of welcome rewards when you fulfill the cumulative deposit tier and other terms and conditions. Remember to sign up using my exclusive link down below or scan the QR code right here to get your Moomoo SG Universal account today. Okay, alternative, if you don't want to look at REITs because you're unable to handle the risk level, then another alternative that I have is to look at bond funds. Especially if you look at Moomoo Income Plus, they have a variety of bond funds that you can choose from, and they have been generating around 4% per annum for the past 12 months based on the date of recording. But please remember, past performance is not a guarantee of future performance. This is what I also invested in based on my past video where I talk about my next cash alternative. To be clear, this is also not capital guaranteed and subject to market fluctuations, but generally, it is at the safer risk level compared to REITs and equities. So if you want to know what is my most updated cash strategy for the month of June, then I'll refer you to watch my previous video right here.